If you're interested in getting your bookkeeping certification, then watch this video. I started the process and I'll explain how it works. So to get started, you can go to the website nacpb.org. That stands for the National Association of Certified Public Bookkeepers. They offer a number of certifications: the bookkeeping certification, payroll, QuickBooks, accounting, accounting analysis, taxes, business tax, or the office manager certification. In order to put the letters CPB after your name, Certified Public Bookkeeper, you have to pass these 4 courses: the bookkeeping test, the payroll test, QuickBooks Online, and accounting. So how do you get started? In my browser, I have this website saved. You could type this into your browser and the info will come up. On the top of the page, it's going to look like this. Then if you scroll down, you get all this information, the steps to becoming a certified public bookkeeper. If you're really comfortable with bookkeeping, you can go straight to the exam. And the exam costs $80 or $100, depending if you're a member or not. But what I did, I bought their course, the Accounting Fundamentals course. That's their bookkeeping course. So if you click this link on top, Accounting Fundamentals, then you'll see this on the page. There's a lot more info, but this is the important stuff. In order to get the course material, you have to pay $3.99 if you're not a member, $3.19 if you're a member. To be a member of NACPB, it costs $200 a year. I'm not a member, so I paid the $3.99 and they gave me access to the course. When you get access, you receive all the test prep material, which are 13 chapters, an ebook, and a video for each chapter. The videos are 15 to 30 minutes long. After I paid the $3.99, they sent me a link to their website for all the studying material. There's 13 chapters. The first 8 are right here. This link down here is the course lectures. They also have an ebook. I didn't use the ebook. What I would do is I would watch the first video on chapter 1, and that gives you an overview of the topics in the chapter. And then I click this drop down. When you click the drop down, it looks like this. This is chapter 1. There's 3 sections. There's a section review, so it's a bunch of multiple choice questions, then a quiz, then a review. It's really helpful. I've actually learned a lot going through their material. Chapter 1 is a little basic. Chapter 2 has a lot more info. There's exercises, problems, etc. So for all 13 chapters, I watched the video, then I went through all the quizzes. They also have a full test, a pre-assessment test and a post-assessment test. So I did all of that. The next step is I need to sign up to take the test. I'm going to probably take it in a few days. If we go back to this page where it lists the steps, I have to click this link, Bookkeeping Certification Exam. And once I click that link, it brings me to a page like this. It shows you the topics on the exam. These are the 13 topics I already studied, some more information, and the price. So I'm going to probably pay $100 since I'm not a member. You either pay $80 or $100. You can pay $80 if you pay $200 a year to become a member. So each test you do save $20 by being a member. And also the courses are cheaper too if you're a member. So once I pay for the test and schedule a date and time, they'll give me access to the test. I could do it from my home, and I have 2 hours to complete it. If I get above 75% on a bookkeeping certification exam, then I'll order the materials for the payroll fundamentals, go through that course. Once I feel prepared for it, I'll book the test. And this may be a little more challenging because I don't have as much experience with payroll as I do with bookkeeping. So even if I fail the test, say I got a 60%, I could just redo the test in a week or 2 until I pass. And I'll do the same process for all 4 tests. They say the average person spends 3 months on each test, on reviewing the material, then taking the test. So the average person takes 1 year to get the certification. I only spent 1 week on the accounting fundamentals. Of course, if you're new to bookkeeping, you might spend a little more time. And it is self-paced. So if you do have a lot more time, you can get it done quicker. If you work a full-time job and have kids, it might take you a little longer. You don't need to buy these courses. You can just take the exams. and pay the $80 or $100. But you do need to pass the exam. And even though I know bookkeeping pretty well, I did take their practice exam on their website and scored 71%, so I would have failed because I need 75% to pass. Because there are lots of things you don't do that often, or you may do once a year, so it's really hard to remember it. I'll show you example questions in each of the 13 chapters later on in the video. Once you pass all 4 exams, then you have to verify you have 1 year of bookkeeping experience. You would just provide them the contact of your boss or previous boss, and they can confirm you did bookkeeping at their company for at least 1 year. If you don't have 1 year bookkeeping experience, then you need to get that in order to get this certification. Then you have to pay $100 for the application. And once that's complete, then you're certified. Every year, though, you have to do 24 hours of continuing professional education and also pay $25 each year to renew your license. They offer courses for CPE, so each year you can buy a course from them, or if you're a member, you might be able to get it for free in order to fulfill those 24 hours of continuing education. Now let's go through all 13 chapters, and I'll give you example questions directly from the company. So the first chapter is accounting, the language of business. And here is one of the quizzes on their test. Which of the following is not a common internal control and fraud prevention policy? A question like this, you might need to know the information because using logic might not work. A question like, if a company bought something on credit, would their liabilities go up or down? You can use logic. If they bought on credit, then their liabilities will go up. But there are some questions you really need to know the material. What's not a common internal control and fraud prevention policy? 1. Requiring written proof that transactions are authorized. That's definitely a policy. Separating duties among employees. That's a policy. Requiring written proof that payments are authorized. That's a policy as well. Preventing multiple payments to a single creditor from being made in one day. That's not a policy. Customers can make as many payments as they want in a day. So that would be the answer. All the questions on their test are multiple choice or true false. The next question, the entity that has final authority over the financial reporting of publicly owned corporations is the SEC, FASB, FTC, or IRS. Some people may think it's the IRS, but it's not. There are some links to FASB and the SEC, but FASB is a private company that works on accounting standards. The answer is the SEC. The SEC is a governmental agency that protects investors, and they're responsible of overseeing financial reporting. The second chapter is analyzing business transactions. When the owner invests cash in a business, assets and revenue increase. Well, if the owner puts cash into the business, assets definitely increase because your cash goes up, but revenue doesn't increase. That's not a sale if you put cash into the business. Assets increase and owner's equity decreases. Well, if owner's equity decreases, the balance sheet wouldn't balance. Liabilities decrease. Liabilities are not affected. The answer is D. Assets and equity increase. Equity is assets minus liabilities. If assets goes up, liabilities or equity have to go up, so the balance sheet balances. And vice versa, if assets go down, liabilities or equity have to go down. It is possible for one asset to go up and another asset to go down. That would also keep the balance sheet in balance. After analyzing its business transactions, a firm has the following ending balances: AP 3400, AR 2000, cash 1000, capital 3600, equipment 3000, prepaid rent 600, and supplies 400. What is the total amount of assets? AP is not an asset, that's a liability. AR is an asset, 2000. Cash is an asset, 1000. Capital is equity. Equipment is an asset, 2,000 plus 1,000 plus 3,000, so we're up to 6,000. Prepaid rent is an asset, 600, and supplies is an asset, 400. So the answer is B, 7,000. Chapter 3, Analyzing Business Transactions Using T Accounts. Which of the following account types are listed last within the chart of accounts? If you use QuickBooks, you'd probably know this answer. Is it income statement accounts, statement of owner's equity accounts, permanent accounts, and balance sheet accounts? Permanent accounts are pretty much balance sheet accounts. It's the same thing. The chart of accounts are listed in this order. First are assets. Usually cash is on top. They're the first account to get listed. After the assets are the liabilities, then the equity accounts, then revenue, then expenses. Expenses are on the income statement. Revenue is also on the income statement. So the answer is A, income statement accounts. Which of the following types of accounts normally have debit balances? In order to get the balance sheet to balance, we have to debit assets when they go up. So when you put cash into a business, we have to debit their assets. That increases assets. And when you credit cash, cash goes down. I know that sounds counterintuitive, but when you do journal entries and look at the balance sheet, it makes a lot of sense. Assets have a natural debit balance, but revenue has a natural credit balance. So it can't be A. Assets have a natural debit balance, but liabilities and equity have a natural credit balance. So it's not B. Expenses and assets have natural debit balances. So the answer is C. Let's take a look at Chapter 4, the General Journal and the General Ledger. The journal entry to record the receipt of cash from clients on account. So if you sold something to a client in the past, that means you booked accounts receivables. And say a month later, they're paying for that product. So you have to record the receipt of cash from that client that bought on credit. So when cash goes up, you debit cash. So we definitely have to debit cash. And that's in A and C. But we didn't sell a product to a customer. We sold the product a month ago. So we can't book income. We already booked the income when we initially sold it. When we initially sold the product, say we sold $100 of goods. In that case, we would debit accounts receivables $100. So accounts receivables goes up 100 and credit income 100. So income goes up 100. We already booked the revenue. So in this case, now that they're paying for the product, we increase cash 100 by debiting cash, and we decrease accounts receivables 100 by crediting accounts receivables. When we want to decrease an asset, we credit it. It will become second nature, but initially it may sound confusing that you would credit an account to lower the balance. But that is the case with asset accounts and expense accounts. The process of transferring data from the journal to the ledger is known as balancing, journalizing, ledgering, posting. This is just one of those things you have to memorize. You post to the ledger, so it's posting. So even if you do bookkeeping every day, sometimes you just forget these terms. Or you might not even post it. The computer does it for you. You just input the numbers, and then QuickBooks does all the posting, journaling, and prepares all the financials. But it's still good for you to know how to do it. Chapter 5, Adjustments and the Worksheet. Centrum Services purchased $4,400 of equipment. The equipment has a useful life of 7 years, salvage of $200. Using straight line depreciation, how much is the first month of depreciation? To calculate that, we take the original value of the asset, $4,400, minus salvage. Since it's 7 years, we multiply it by 12 months in a year, so 84 months. So each month, $50 of depreciation. So the answer is 50. Some people forget to minus the $200 of salvage. And if you forget, then you would get $52.38, which is the wrong answer. If they had zero salvage value, that would be the answer, $52.38. Some people divide by 7 years instead of 84 months. And if you did that, divide by 7, you would get 600. That's how much is depreciated over 1 year. But the question is for 1 month. If an adjusting entry relating to prepaid insurance is not entered onto the worksheet, assets on the balance sheet will be, so when you buy insurance, you might pay for 3 years of insurance and carry those 3 years on the balance sheet. And then each year depreciate 1/3 of that amount you put in the balance sheet. If you pay for 3 years of insurance, you paid $3,000. Each year, you would take $1,000 off the balance sheet and put it onto the income statement as an expense, as an insurance expense. But if you didn't do that, you kept it on the balance sheet and forgot to expense the insurance, that means you have less expenses on your income statement. When you leave out expenses, it inflates your net income. But they're not asking that. They're saying, how does it affect the balance sheet? Well, the balance sheet has $3,000 of insurance, prepaid insurance. It should have $2,000, but you forgot to take it off and expense it. So you're overstating your balance sheet. So the answer is A, the assets on your balance sheet will be overstated. Chapter 6, Closing Entries and the Post-Closing Trial Balance. Which of the following journal entries would be used to close a fees income account with a $4,200 balance at the end of the year? At the end of the year, you have to zero out your income statement. In order to zero out your income statement, your revenue, they call it fees income, has a credit balance. In this case, it's $4,200. How do you zero out a credit balance? You have to debit your revenue, $4,200. Every journal entry starts with a debit, but you could also tell the left side is a debit, the right side is the credit. So you need to find where it says fees income, $4,200 on top. That's not it. There's $4,200 on top. This is also $4,200 on top for fees income. So you have to debit fees income $4,200. But what account do you credit? Part of the closing process is to zero out all revenue and all expenses and put it into income summary. That's step 1 and step 2 of the closing process. Step 3 is to move the amount from income summary to your capital. So the answer would be B. You move your revenue to the income summary account. The next step of the closing process is to debit income summary. In this case, you would debit $4,200 and credit capital $4,200. So you move all your income to your capital or retained earnings. Chapter 7, Accounting for Sales, Accounts Receivable, and Cash Receipts. The Sales, Returns, and Allowances account is a asset account, contra liability account, expense account, contra revenue account. So if you sell $1,000 of product to a customer and they say $100 of the product is defective, so they send it back, you shouldn't reduce revenue 100. You should post out 100 to sales, returns, and allowances so you can track it. You could track your returns. And sales, returns, and allowances lowers your revenue account. So it's a contra revenue account. Revenue accounts have a natural credit balance. This is a contra revenue account, so it has a natural debit balance. If an invoice lists 2/10, N/30, which of the following sales discounts is being offered to the buyer? 2%, $10, 20%, 30%. This means if the customer pays within 10 days, they could take a 2% discount on their order, but it's net 30. They have to pay within 30 days. So if they pay after 10 days, they get no discount. So the answer is A, 2%. Chapter 8, Accounting for Purchases, Accounts Payable, and Cash Payments. Which of the following specifies the exact terms, quantity, price, and credit terms for a merchandise purchase and is signed by someone with authority to approve purchases? This might be one of those things you just have to memorize, because that term is a purchase order. That's what that means. The other three do have different meanings, but if you work in a company that has POs, that's what we call purchase orders, then this may be a simple question for you. A firm had purchases of $10,000, freight charges of $1,100, and returns and allowances of $2,400. What are the cost of purchases? The cost has to include the freight, so it's $10,000 plus $1,100, that's $11,100. Then we have to minus $2,400. So the answer is $8,700. That's how much this company paid for this purchase, $8,700, since they returned $2,400. Freight, taxes, and discounts, that's all part of the purchase. That has to be built in. A discount store or retail business keeps a $200 change fund in its cash register. If they had cash sales on September 29th of $700, according to the tape on the cash register, but they had $904 in the cash register at the end of the day, then were they over or under, and how much? Remember, they always keep $200 in the register. So since they had $700 in sales, you would expect $900 in cash to be in the register. they had 904. So they're over by $4. The answer is C. It is common to be over or under by a few dollars. It's really due to human error. The person at the cash register might make a mistake. If you're off a lot, like you're really under, say there was only $500 in the cash register and you had $700 in sales plus a $200 buffer, then somebody may be stealing from you. Upon collection of the amount due on interest-bearing promissory notes, you would debit cash, credit notes receivable. A promissory note is an IOU. In this case, the customer signed a note saying they're going to pay us a certain amount of money with a certain interest rate. So if we receive payment from the customer, we would definitely debit cash, whatever they paid us, because cash goes up. We would credit notes receivables because this goes down. The notes receivables goes down. It goes down by the principal amount. What else will we do? Well, we know we received interest from the customer. So how do we book that? You might think debit interest expense, because that would increase your interest expense. But you would only debit interest expense if the interest was tied to your day-to-day business. A promissory note is usually not what a company does, unless that's all your company did, buy and sell promissory notes. Most companies don't do that. So in this case, you would credit interest income because interest income goes up. That's how you increase an income account. You credit it. Chapter 10, Payroll Computations, Records, and Payment. Which of the following statements is not correct? The FUTA tax provides benefits for employees who become unemployed. This is the Federal Unemployment Tax Act. And the purpose of FUTA is to provide benefits to people who are out of work. So that's definitely correct. FUTA is withheld from employees and the employer. Actually, only the employer pays into the FUTA fund. Employees do not pay anything, so that's not correct. The FUTA tax rate can be as low as 0.6%. That is true. FUTA is 6%. The State Unemployment Tax Act is 5.4%. But the way it works is FUTA provides a credit for SUTA. So if you're already paying SUTA, the 5.4%, you can minus that out from your 6% FUTA. So you could lower your FUTA to 6% minus 5.4%, or you can lower it to 0.6%. So that's definitely correct. And the fourth one, the state unemployment taxes are paid entirely by the employer. That's definitely correct. So the answer is B. An employee whose regular hourly rate is $12 and whose overtime rate is 1.5 times the regular rate worked, in 1 week they worked 43 hours. When an hourly worker works above 40 hours, they get time and a half. So for 3 hours, they get time and a half. Time and a half for this employee is $18, 12 times 1.5. So the answer is not 18, it's 54, 3 times 18. The 11th chapter, Payroll Taxes, Deposits, and Reports. Which of the following forms is not filed on an annual basis? If you file tax returns and tax forms, this is easy. But if you don't, you may have to memorize this one. Each employee gets a W-2 every year, that's annually. The W-3 form summarizes all the taxes the company paid for the entire year. It combines all your employee taxes. So that's annual. Form 940 is when a company reports their FUTA taxes for the year, federal unemployment taxes. The Form 941 is a company's quarterly federal tax return. So the answer would be D. Which of the following is not a destination where an employer might send Form W-2? Well, you definitely send it to the Social Security Administration. The employee definitely needs a copy to do their tax returns. The state needs a copy as well. The workers' comp insurance provider does not need a copy. The answer is B. Chapter 12, Accruals, Deferrals, and the Worksheet. Allowance for doubtful accounts is deducted from sales in the revenue section of the income statement. We know purchases, returns, and allowances reduces revenue, not allowance for doubtful accounts. Let's see. Allowance for doubtful accounts is listed in the liability section of the balance sheet. No, it's not. It's listed in the asset section. Allowance for doubtful accounts is listed in the operating expenses section of the income statement. That's not correct. We know it's in the asset section. Allowance for doubtful accounts is subtracted from accounts receivables in the asset section of the balance sheet. That's the purpose of allowance for doubtful accounts. It's the money you're likely not to get when you sell on credit. Because when you sell products on credit to a customer, not everybody pays. You want everybody to pay, but you have to assume maybe 5%, maybe 10% won't get paid. You need to look at the number historically and then assume that for each sale. Which of the following statements regarding the accrual basis of accounting is accurate? Revenue is recognized when earned. That's definitely accurate. While expenses are recognized when cash is paid. That's cash accounting, not accrual accounting. That's wrong. Revenue is recognized when cash is received. That's definitely incorrect. D has the same thing, cash is received, so that's not right. Accrual accounting, the definition is revenue is recognized when earned, expenses are recognized when incurred. Cash has nothing to do with accrual accounting. The last chapter, Chapter 13, Financial Statements and Closing Procedures. The beginning capital balance on a statement of owner's equity is $72,000. Net income $21,000. Owner withdrew $4,000. What is the owner's capital at the end of the period? Well, capital equals beginning capital $72,000 plus net income of $21,000 minus owner withdrawals of $4,000. So that's $93,000 minus $4,000. $89,000 is the answer. Say they had a net loss of $21,000. Then it would be $72,000 minus $21,000, which is $51,000, minus $4,000, $47,000. But it was a net profit, net income. In the closing entry process, the owner's drawing account is closed in. In this case, it's step 4. The first step of the closing process is to zero out revenue. So you debit your revenue, you credit income summary. The second step is to zero out expenses. Expenses have a natural debit balance, so you credit each individual expense account, then debit income summary. And let's say your net income is $10,000. So you debit income summary $10,000 because that's where your net profit is in that account income summary, and you credit your capital account $10,000. And the last step of the closing process is if the owner withdrew money from the company. Say they withdrew $4,000. A withdrawal has a natural debit balance. So you credit the withdrawal account $4,000 and you debit your capital account. Because capital goes down, your equity goes down when the owner takes money out of the company. Obviously, there's a lot more involved than the questions I've gone over. Because each section you could spend several hours on, sometimes several days. So there's a lot to learn. And I think this is a great course. I'm just brushing up on my skills. Whether you're brushing up on things or you're totally new to bookkeeping, you're going to learn a ton. I hope you enjoyed the video. Let me know what you think. Leave a like, subscribe, or comment below. Thanks for watching.